Welcome to Talk Tickers.
Today, we're diving into a seismic event unfolding in high-end commerce.
A huge one. We're talking about the imminent Chapter 11 bankruptcy filing of Saks Global Enterprises.
And this is so crucial because the collapse of Saks Global, the parent of Saks Fifth Avenue, Neiman Marcus, Bergdorf Goodman, it isn't just about bad management.
No, it's much bigger than that.
It's a critical case study. It shows how this toxic cocktail of aggressive debt and massive market shifts can just dismantle even the most storied luxury brands.
So today, we need to unpack that debt spiral. We'll look at the turbulence hitting the whole luxury sector.
And most importantly, we have to identify what the winning players are doing to survive and even thrive during this kind of downturn.
Okay, so let's start with the immediate news, the results snapshot.
Right.
Saks Global Enterprises is planning to file for Chapter 11 bankruptcy protection, and it could happen as soon as this Sunday, January 11th.
And this comes right after the company missed a critical $100 million interest payment that was due back on December 30th.
And that missed payment wasn't just some technicality, was it?
Oh, no, not at all. It triggered immediate devastating consequences. S&P Global Ratings wasted absolutely no time. They downgraded the company's credit rating to selective default, SD.
Which sounds technical, but what does that actually mean?
It means the company is already failing. It's a formal stamp that says, while they might be paying some bills, they've officially failed on a major obligation. It just shatters any remaining trust from lenders, from vendors, anyone.
So the clock is ticking. The focus right now is all on liquidity.
100%. And what's really striking is how they're approaching Chapter 11. They're filing without a formal restructuring agreement already in place.
A pre-pack, as they call it.
Exactly. They're planning to hammer that deal out after they file, which, adds a huge layer of uncertainty to the whole process.
Well, how do you keep the lights on? How do you keep product on the shelves while all that is happening?
You need a lifeline. And that lifeline is a crucial $1.25 billion debtor-in-possession financing package, a DIP loan. This funding is absolutely essential. It's the cash that lets them keep operating during the bankruptcy. But more critically, it's how they go to their vendors and say, we can pay you now.
It restores that broken supply chain.
It's the only way. It's the money they need to settle those overdue payments and convince brands that if they ship a new order, they'll actually get paid.
That puts it all into perspective.
Okay.
But the deeper question is still there. How did we even get here? A year ago, this was a merger of Icon Saks, Neiman Marcus, Bergdorf Goodman.
It was a deal that was, frankly, doomed from the start. It was built not on strategy, but on a mountain of debt and just wildly aggressive assumptions.
This was the $2.7 billion deal from July 2024, led by Hudson's Bay.
Right. And the goal was to create this luxury powerhouse that could fight online competition. It even had big names like Amazon and Salesforce come in as equity investors, sort of blessing the whole strategy.
So it had market validation on the surface.
On the surface, yes. But the financial foundation was broken. Saks took on about $2.2 billion of debt for the acquisition.
Piling debt on top of a company that was already losing money.
And losing money in a slowing luxury market. They needed everything to go perfectly. The entire bet was on management hitting a target of $600 million in annual cost savings over 5 years.
A huge number, which we now know they never achieved.
Never even came close. They bet the farm on a big luxury market recovery in 2025 that just didn't happen. And that made the debt load completely unsustainable.
And that's when you see the financial consequences just start to cascade.
Absolutely. The debt servicing became impossible. They started burning through cash. By last June 2025, they had to go back to investors for another $600 million just to stay afloat.
And then came the big public warning sign in October.
That's when they had to just slash their full year earnings target dramatically.
And the scale of that cut is just staggering. They took it from a range of, $275 to $325 million.
All the way down to a range of $140 to $160 million.
That's basically a 50% wipeout of their expected earnings in months.
Exactly. And that financial rot immediately turned into an operational spiral. This is where the numbers hit the real world. A free operating cash flow deficit of $410 million.
And FOCF, that's the cash the business actually generates after all its expenses. A deficit like that is a disaster.
It means you have to choose who you're not going to pay. And for a retailer, the easiest choice is often your vendors. We heard some suppliers were owed six-figure payments going all the way back to August.
So the vendor crisis wasn't a side effect of the collapse.
Yeah.
It was the collapse.
It was the cause. You can't be a luxury department store with no luxury goods. When you stop paying your suppliers, they stop supplying. By January, over 100 brands, crucial high-margin brands, had just stopped shipping to them.
Which creates an inventory crisis, which leads to a revenue drop.
A Q2 revenue drop of over 13%. They tried some last-ditch moves, selling the Neiman Marcus property in Beverly Hills, replacing the CEO, but it was far too little, too late.
It's just jarring. But let's zoom out a bit, because its failure tells us something bigger about the department store model itself, doesn't it?
It tells us that the highly leveraged, multi-brand luxury retail model is structurally shrinking. It's in retreat.
We're seeing it already. Saks OFF 5th is closing 9 stores, including its flagship on the Upper East Side.
And that's part of a much bigger trend. Analysts are expecting maybe 45,000 U.S. store closures by 2029. The whole model is losing relevance as people move online or to direct-to-consumer experiences.
But there's this huge real estate paradox here. The stores are failing, but the land they sit on is incredibly valuable.
Oh, absolutely. The Saks global property portfolio is still valued near $4 billion. That Fifth Avenue flagship is a crown jewel of real estate.
So even if the store survives, the financial logic might be to turn it into condos or office space?
The cold calculus of finance says the highest value for that land may not be retail, and it's all part of the severe turbulence we're seeing in the luxury industry, driven by macro uncertainty and a downturn in Asia.
Which brings us to luxury fatigue. This feels like the core of the problem. Brands just assumed customers would keep paying more and more.
And that faith was completely misplaced. Luxury brand prices shot up 54% since 2019. But here's the key statistic. 80% of the market growth in that period came from price hikes, not from selling more stuff.
80%. They were just raising prices on the same customers.
And that strategy is not sustainable. It breaks the trust between the brand and the consumer, especially the aspirational mid-tier one. You get product rejection.
Like with champagne.
A perfect example. Prices rose over 40% since 2022, and people just started saying no. It was too expensive for what it was.
So this forces brands into a huge strategic choice. Either go all in on the super rich, the VICs,
or completely rethink accessible luxury. And the successful players, the LVMHs of the world, are executing these strategies perfectly. They are focusing relentlessly on the ultra-rich.
the VICs. The top 2% of customers who drive something like 40% of revenue.
Exactly. This group is insulated from inflation. So LVMH is pushing extreme exclusivity, a 10,000 euro bottle of Hennessy, or the appointment-only apartment boutique in Singapore. They're raising the barrier to entry, not lowering it.
And operationally, how are they avoiding the spiral that killed Saks?
Operational excellence, a ruthless focus on cost. 75% of industry pros say supply chain optimization is their top priority.
So where do those savings come from?
It's things like zero-based budgeting, or ZBB.
Can you define that for us?
Sure. It just means you start every year's budget at zero. You have to justify every single expense from scratch instead of just adding 5% to last year's budget. It forces discipline.
And technology, too.
A huge part of it. Kering reportedly cut its overstock by 30% using AI systems to better predict demand. It's about efficiency.
And beyond efficiency, there's diversification, moving away from just selling expensive bags.
Yes. Over half of professionals see diversification into services as key. The top categories are luxury hospitality. LVMH is expanding its Cheval Blanc and Vlvgari hotels, and beauty and wellness.
Why those two?
They're higher margin, less vulnerable to supply chain shocks, and they create an experience that builds loyalty. Louis Vuitton launching cosmetics is a perfect example. It's an accessible entry point into their brand ecosystem.
It all points to this big trend, a return to fundamentals, away from chasing fads like NFTs.
Which really had limited utility beyond authentication. Now the focus is back on heritage, craftsmanship, things that actually justify the high price. Innovation now serves quality, like Hublot's unscratchable magic gold.
It's about making the store visit an event, an experience, not just a transaction.
And that's the model that's winning. Saks failed because it substituted debt for a real value proposition. They were the over-leveraged middleman, and the industry is now cutting that middleman out.
All right, that brings us to our favorite segment, where we pitch an outrageous but plausible trade idea. And as always, a reminder, this is not financial advice.
Of course not. But the idea is based on clear market signals. The failure of a giant like Saks Global clears the path for the huge capitalized conglomerates that already control everything.
So our trade idea is to go long LVMH, or a similar vertically integrated player. The logic is a bit counterintuitive.
Right. The collapse of a major competitor like Saks actually benefits LVMH. Well, first, it cements their pricing power. There's one less major distributor to challenge their direct-to-consumer model.
And maybe more importantly, the assets. This allows a giant like LVMH to potentially acquire prime real estate like that Fifth Avenue flagship at a huge discount.
Exactly. It's the final stage of consolidation. They buy the prime assets from their failed competitors, turn them into their own branded experience centers, and cut out the department store for good.
The Saks bankruptcy is really a cautionary tale then, about leverage, about failed assumptions in a market that is changing so fast.
The takeaway for the whole luxury sector is that they have to repair that bond of trust they broke with all those price hikes. They need to reinforce quality, craftsmanship, and exclusive experiences.
Give the customer a real reason to aspire again.
A return to the core truth of luxury.
Precisely. So, as we close, here's a thought for you to mull over. Considering this massive shift to D2C and luxury experiences, which remaining American department store do you think is most vulnerable to the Saks spiral?
And what prime piece of real estate will be the ultimate prize when it falls?
That's it for this deep dive. Thank you for joining us on Talk Tickers. We'll see you next time.